Alright, welcome to today's video everyone. So in this supply and demand series today, we'll be covering order blocks. So some goals that we should be able to achieve by the end of this video is to understand what order blocks are, how to properly identify order blocks, and understanding key concepts that we can use when it comes to order blocks, and how we can use order blocks to our advantage. So some key words I just want to cover are order blocks. So these are just your supply and demand zones. Now liquidity is just an area with resting orders, stop losses, and pending orders, and take profits and stuff like that. Now indecision is just doji candles you see on the charts, or consolidation periods where the market's just moving sideways. Now imbalance is just inefficient price action. And premium and discounted zones. So premium are areas we want to be selling from, and discounted areas are those demand zones we want to be buying from. Alright, so now we'll just cover identifying and drawing zones. So this is probably one of the most important concepts about this strategy. It is the understanding of drawing the right zones. So a zone on the chart is an area you can clearly identify a large order being placed in the market. You notice the big order being placed and a rapid move happens away from the area, creating imbalance and possibly breaking structure. The candle before the big rapid move will be what we use to mark our zones from. So with that being said, we'll move forward to identifying some zones now, and I'll show you some concepts of how you can identify that previous candle or just that whole order block. There's more ways to draw zones. You don't have to just look for a doji candle. I would say it's the most traditional way, but there's definitely more ways to draw up a zone. So with this example one over here, it's clearly not a doji candle, and I've just drawn the zone up from the previous wick low to the wick high. So always start left to right. So started the markup from the previous up candle's low and the next candle's wick high. And this is a great zone because this down move was impulsive and it did engulf that whole previous candle. So this should be a high probable zone. So moving on to this one here, it's nothing like a doji or even this previous candle here. It didn't engulf it, but we did get an impulsive move to the downside. And the way we marked this up was from the previous wick low again and the next wick high. But there's another way we can draw this zone up, and this is the way that I would do it. So I would mark it up from this low here. So my zone would look like this. I'd mark it up from this wick low to this wick high with just this candle here, only because the imbalance follows this part here, and you do get more of a premium entry on this zone here. So marking it up from here to here is completely fine. It's just personal preference, and that's what you'll find with majority of your zones. So it'll all be personal preference, what sort of risk you can tolerate and whatnot. So this zone here to this one up here, it's obviously more conservative and you may get more entries, but you'll just have a smaller risk to reward in the end, because obviously from here to here there's a bit more of a price gap, so you would actually miss out on a little bit, but that's completely fine if that's the sort of trader you are. Now this candle over here, this zone shows that sellers are coming into control just because there's no top wick on this candle. So the push to the downside, the impulsive move that we're looking for, is actually a bit stronger just because sellers have completely taken control of the market from where this candle opened and closed. So I just want to say it again, marking up your zones is strictly just personal preference. There's no right or wrong if you know it works. So once you've found out the way that best suits your trading personality, then stick with it. But there are concepts that you do want to use and incorporate with your zone markups, because obviously if you mark up a zone that's not valid, it's obviously going to be very hard to catch a trade from. So you do want to incorporate all these concepts that we're going to go over, and yeah, just find the perfect zone markup for you and just work with that. Alright, so now just go over some different ways we can draw up our zones. So again, this is all personal preference. And as you can see, this one's drawn up from wick to wick. So I would say it's also the most traditional way. And personally, this is the way I draw up my zones. Just because I feel like we actually do get into more trades this way, and the risk to reward is still attractive. So zone type 2, we're getting more aggressive with it, and there's more of a chance of missing out on a trade because we are looking for only a couple pips more discounted, and we do have a tighter stop loss placement here, so it does get more aggressive, and that comes with more risk as well. So same with zone type 3. I do see traders do it like this. Personally, it's just not for me. It's just too risky this way because you just have a very tight stop loss placement, and you do miss out on a lot of trades. So I like to stick with this traditional way, wick to wick. But that's just me and my personal preference. So maybe yours might be different. Just play around with it, see what you prefer. So now I'll go over identifying and drawing zones. Some key things I look for when I'm trying to identify some high probable zones. So first I'll start off with a consolidation period and then liquidity. So with the consolidation period, essentially that's the market building up liquidity on both sides of the market. And if one side gets taken out on an impulsive move, that takes out either buy side or sell side liquidity. So moving on to liquidity, that's one form of liquidity that I just spoke about then. Or we can look for those equal highs, equal lows, or trendline liquidity that's in the market. We want to wait for that to be taken out, so our zone sweeps that form of liquidity that's in the market and impulses to the upside or downside. So indecision are those doji candles or consolidation periods. Now, I want to see the zone create some high volume and a strong move that leaves behind imbalance, and the zone must be in a premium area to sell and a discounted area to buy. Alright, so now I'll just cover premium and discounted zones. So when identifying multiple zones, you go with the zone that is in the discounted or premium levels. Equilibrium is the midpoint of a price range or midpoint of a swing. It's a level where the price is neither cheap nor expensive. This isn't a point you want to execute a trade-off. We want to be buying at a point that is below the equilibrium or selling at a point that is higher than the equilibrium. Now, the methodology of this idea is to get the best risk to reward and the highest probability trade. To find these levels, I simply use the fib tool and mark from my swing points. So for the premium supply zone, I'll mark from the swing high to the swing low. And for a discounted demand zone, I'll mark from the swing low to the swing high. Alright, so now this is a buy to sell candle. So this won't be a doji candle, instead it'll be a strong candle with very little wicks either side. So as you can see here, we don't have a doji candle that we have marked our zone from. Instead, it's a very strong sell to buy candle, and we get very little wicks. Price did trade down this low to take out these equal lows here. So again, with our consolidation period, so those market makers have driven the price down to then drive the price up, and obviously taken out those highs of this consolidation as well as breaking structure. So this is why we were able to catch this trade and hit TP. So this supply zone over here, we have a pretty strong buy to sell candle here again. We did get that impulsive move to the downside, which broke structure. And as you can see, we've just marked from the open of the last buy candle here and marked it up from the high of the previous wick. Now we were able to catch this trade here because we had some resting liquidity just below the zone as well. So typically, I feel like the buy to sell candles are the high probable trades, just because you can tell that they've created a strong move behind them just from those candles itself. Alright, so moving on to liquidity now. So to keep it simple, liquidity is just an area with resting orders, stop losses, and pending orders. Essentially, we are all liquidity, but that does not necessarily mean all orders must be taken out by smart money, as some areas of liquidity are not liquidated enough for it to be worth the grab. The most popular areas are where retail traders usually execute a position from. So these areas are support and resistance areas, so you'll see equal highs and equal lows on your charts. These areas typically work best with wicks because retail traders like to place their stop losses at the highs or lows of these wicks. Now for trend lines, retail traders like to trade off the touches of each trend line. Us smart money traders look at these trend lines and use them for liquidity, so we'll wait for those breaks of the trend line to come down into our area of interest, and then that's our form of trend line liquidity to take out those retail traders. Now for fib levels, I like to use the 6180, also known as the golden zone for the retail traders. I use this level on my chart as an inducement sort of liquidity. So essentially, I wait for the retail traders to execute their positions from this golden zone fib level, and then the trade will go in their direction, but shortly after, it'll come back into my area of interest, taking them out, inducing them into the trade, where my area will be more liquid because those traders entered the market too early. So I go over this in my supply and demand program a little bit more in detail. So if you're interested in that, it's just linked down below. Alright, so these areas have lots of orders placed as retail traders have been taught to buy and sell from these areas. So knowing this, smart money would aim for all the stop losses placed above and below these areas, so it would be worth the grab. The point of using liquidity as our confluence is we want to be the first to get into the trade, so everyone else that also gets in helps drive the price into our desired direction. You always want to identify where the liquidity is because you don't want to become the liquidity. The point of using liquidity as our confluence is we want to trade with the smart money so we are in harmony with the market makers. So here are some liquidity concepts to identify. So over here with our consolidation periods, as I spoke about earlier, normally those will occur in the Asian session. So as you can see, we have Asian lows and Asian highs here. Also, you can see we've got equal highs, equal lows. So these are areas where retail traders are also executing their positions from. So this is a very liquid area. Once these areas have been taken out, which from both sides got taken out, and for us, we just had a waiting game to play. We've marked up our zone, and the zone tapped straight in and took off. So again, as you can see over here, we had some trendline liquidity build up. It doesn't seem like a massive trend. If you go down to lower time frame, it's definitely more noticeable then. But even stuff like this, it's a great form of liquidity. And as you can see, our zone here has swept the liquidity, traded down, broke structure. So now we are looking for sells. And we also get these equal highs in the market that we take out, that those retail traders are executing their shorts off way too early. So we're able to get into the market and take this trade. Alright, so now imbalance, I just want to go over some keywords because there are different terms always used about imbalance, and I just want to clear up some of the terms you might hear. So I have mentioned inefficiency in this video. You might hear that getting thrown around, same with FVG and void. So don't get confused about these terms, they all mean the same thing, and there's nothing different about them at all. So inefficiency, you'll hear that getting used as calling the price action inefficient. Now FVG just means fair value gap, and void just means there's basically a gap in the market that needs to be filled because it's inefficient price action. So they all just mean the same thing, so don't get confused with hearing all these different terms about imbalance. Alright, so now using imbalance is super important. So this is the trade that I was showing you before. So we have our imbalance that is just above our zone, that the market comes back and fills the inefficient price action, fills it and trades into our desired direction almost straight away. So as you can see, this trade over here went completely wrong. It's a valid zone, but as you can see down here, we have inefficient price action that needs to be filled. And as you can see, price did come back and fill all this inefficiency that the market has created. So even though this zone here had imbalance ready for us to fill and take this trade into our desired direction up here, that did not happen because we had imbalance below our zone, which I always heavily go over with my students, that we do not take trades without any sort of confirmation when we have imbalance above or below our zones, depending what side of the market. If we're trying to go long and we've got imbalance below our zone, then I'm always looking for some sort of confirmation to get into this zone here. But if no confirmation happens, price is most likely going to come back and fill all this inefficient price action in here. So that's why this trade went wrong. And that's why this one was able to successfully trade into our desired direction here. Because all the price action was efficient enough that all it needed to do was come back and fill this area here and then trade into our desired direction. Alright, so now I just want to jump onto the charts and break down this trade that me and the students actually got to take in our Discord server. So if you're wanting to be able to take the same trades as us, just go down to the link below and there'll be a link there, link to our Discord server. And while you're there, don't forget to like, comment and subscribe to the video and comment some things that you want to see in the future. Alright, so we'll go over this trade here. So we're on the 15-minute time frame at the moment. That's where we caught this first trade from. But over here we had an order block on the 1 hour time frame. So we'll just head over to the 1 hour. Alright. So we didn't take this first one here just because it was a little bit sloppy and we got a failed demand over here. So we had a failed demand over here, so we didn't take this one. But we did get a great reaction and price created some nice liquidity for us to... And we got some nice liquidity that price created for us here. Now, we had this area where we... Now we had this order block area where we had some nice imbalance here that we're going to start looking for some longs from. So price mitigated that, very nice. Then we got this order block in the 15-minute time frame that we refined down very nicely. We had this trendline liquidity with lots of retail traders getting into the market for longs. And then they got taken out very quick. We got our imbalance that we were looking for. So the imbalance starts from here to here because price did come back and fill in this inefficient price action here. So this is our imbalance in this box here. Now this is a form of sell-side liquidity here, where traders were induced into the market too early again, where we were able to set our buy limits just here at this zone, place our stop loss, place it here, and we targeted these highs here for the buy side liquidity. Now price did that very perfect Also created a 5-minute order block. Can't show you because the data doesn't go back that far. But we had a very nice 5-minute order block. We were able to take this trade because we got some imbalance on the 5-minute time frame. We get a imbalance on the 5-minute time frame. We got those early buys that got into the market here. And we also got this big imbalance that price needed to come back and fill. So as soon as we got tapped into our trade, price automatically reversed, came back to fill this inefficient price action straight away. And we targeted a 5-minute supply zone here. And it automatically hit take profit and reversed, and then traded to break structure to the upside. So now we know that we are going to continue to look for some more buys in the future. Alright, so that's the end of the video, guys. So hopefully you have enjoyed it and got some great information from this video. If you have any questions, just comment down below, or you can join our Discord server and chat to us every single day and even get to meet some new traders. So if you like the video, please leave a like and subscribe, and turn the post notifications on to get updated for when we post next. Alright, take it easy, guys.